Peace and love, good people. Peace and love. Let's get right back into it. 3 common mistakes in single options trading. All right. There are many risks involved with trading out of the money options, options with short expiration dates, and trading without a plan. Listen, if you are trading without a plan, I want you to join the Patreon. We have a plan prepared for you for educational purposes only. This is not financial advice, and I am not your financial advisor. Now, understand the importance of picking a strategy that works for you and why you should stick to the plan and not let your emotions get the best of you. All right, so number 1, over investing in speculative OTM options. Now, OTM means out of the money. So there is a concept in trading known as moneyness. All right, I want y'all to look that up. Moneyness. All right, out of the money, at the money, in the money. All right, out of the money options can seem appealing to new traders since they cost less than options that are ATM or ITM, at the money or in the money. The cheap cost of an OTM option seems ideal if you're trying to follow the strategy of buying low and selling high. When buying an OTM call option, you're hoping for it to move into the money, letting you buy the stock at a discount that exceeds the premium you paid. Sometimes this strategy works, but it's difficult to consistently succeed if you're always betting on your out of the money positions to move into the money. Focusing only on buying OTM options is likely to cause more loss than profit. Okay, so if the stock price is $10 and you buy a call option for $16, you're betting that by the expiration date, the price of the stock will rise from $10 toward $16. Ideally to $16 by the expiration date. So that's out of the money because when you buy the stock, it's outside of the current price. Now, if the stock is $10 and you buy a call option for $9 or $8, now you are in the money. All right. And if the stock price is $10 and you buy a call for $10, you are at the money. All right. So in the money, out of the money, at the money. Hey there, future trading champions. If you're tired of feeling lost in the charts and want to take your trading game to the next level, my Patreon is the answer. Join me for exclusive access to my most insightful chart trading videos, a swing trading checklist, and a dedicated series that breaks down the art of charting for beginners. Plus, you'll get entry to my video vault and the chance to ask your burning questions directly in the Stock Market Daddy strategy room. Ready to level up your trading? Let's dive in. Link in the description. Peace and love, and I hope you get rich. Under the right circumstances, a covered call writing strategy can help investors achieve the same goals, but with a more conservative risk profile. All right, so under the right circumstances, a covered call writing strategy can help investors achieve the same goals, but with a more conservative risk profile. Imagine that instead of buying the out of the money option, you simply buy the long stock position at market price and sell that same option against it. Your option is collateralized by the long stock position in your account. All right, let me say that again because I was a little choppy with that. My apologies. Your option is collateralized by the long stock option in your account. So they're talking about instead of buying out of the money call options, they're encouraging you to sell call options. They call this a covered call. So what are we talking about here? We're talking about buying 100 shares. So for example, if the stock is $10 a share, with an out of the money option, you might pay $300 betting that the stock is going to go from $10 to $17 in 2 weeks, right? But if you buy a covered call, if you sell a covered call, instead of paying $300 to buy the option, you would buy 100 shares of the stock. So you would pay $1,000 for 100 shares of the stock. However, the benefit to this is that now you own the stock. This is what they mean when they say your option is collateralized by the long stock option and the long stock position in your account. So now you have 100 shares, and instead of buying an out of the money option for $300, you take that $1,000, that $100 shares you have, you sell an option against it. So now you'll get a premium. So instead of you buying it for $100, instead of you buying the option for $300, now you're going to sell that option. So instead of being a buyer of options, they're encouraging you to buy shares and be a seller of options. I hope that didn't go over your head. You effectively reduce the amount you paid for the stock by collecting a premium instead of giving up the premium to buy the option for a chance of getting the stock. This only works when the option remains OTM and expires without being exercised. But when it works, it achieves the same goal as buying OTM call options. And most importantly, it keeps the investor on the safer side of the exercise. Of course, no strategy is entirely without risk. In the event that your short OTM option moves ITM and gets exercised, you still come out ahead for having collected the premium, but you miss out on the opportunity to profit from future gains. You can also retain the downside risk of the stock. If the stock price declines by a greater amount than the premium you received, you'll have a net loss on the position. All right, so the first mistake, let's just recap because that was a lot. There's 3 common mistakes in single options trading according to Webull Learn. All right. Now, the first one is over investing in speculative out of the money options. So the problem is short-term betting. So you're betting 1 week, 2 weeks, 3 weeks, basically less than a month and a half. So anything less than 45 days to expiration is short. That's just what it is. It's short. It's short-sighted. You don't have the patience for the long game. So if you're buying short-sighted options, they're saying that's problematic because you're going to lose more than you win. And if you don't have a great risk management strategy, you have to be disciplined and excellent. If not, if you're a newbie and a beginner and you're still developing, you're better off the solution, selling covered calls. All right. So beginners are over investing in speculative, short-term, out of the money options. That's a problem. What is the solution? Don't buy out of the short-term, out of the money options. Sell covered calls. Pick a stock where you can buy 100 shares. Maybe it's maybe right now we can go out and look at stocks under $15. So I'll make a video of stocks under $15 for you to look at and consider. And instead of you paying $400 for the option, or $60 for the options, you can sell covered calls and receive the $60 as a premium. Less risk, smaller reward, but more consistent of a reward. All right. So number 2, ignoring faster time decay when approaching expiration. When buying an option, it is crucial to consider the effect of time decay on how profitable your position is. This is something that you will continue to get beat up on if you don't get a lot of reps in or do some serious studying. You want to understand delta and theta. Okay, get in tune, get comfortable, get familiar with your Greeks. All right, so When buying options, it is crucial to consider the effect of time decay on how profitable your position is. When choosing an expiration date, you should factor in how long you think you need to hold the position for your strategy to play out. Time decay plays a major role in this analysis. The value of an option decreases as the expiration date nears, as every passing day leaves less time for the position to turn profitable. Alright, so time decay is eating away at the value of your option. Options with less time until expiration have a cheaper premium. As the time value of the option has diminished, when buying these options, you are risking not having enough time for your strategy to play out and turn a profit. All right, I'm sorry about that. Options with less time until expiration have a cheaper premium. All right, so short-term options are more affordable as the time value of the options has diminished. When buying these options, you are risking not having enough time for your strategy to play out and turn a profit. We need time to cook. All right, time decay is always a factor in options trading, as time value is always a factor in option pricing. All right, so the theta gator. Delta is telling you the value of your option per contract, and the theta is the alligator that's eating away at the profit. So if when you buy it today, you have a 60 delta, you might have a high theta. So every day you're going from $60 to $55 to $48, and you will go from a 60 delta to a 10 delta extremely fast if you have a short-term expiration date. All right, number 3, not having or executing your exit plan. A good exit plan has an upside exit point and a downside exit point, a stop loss. The upside exit point is the price at which you'll close a position while you are still profiting. A take profit, rather than continuing to risk your accrued gains. A downside exit point is the price at which you'll close a position, accepting your losses rather than trying to hold on for the chance of an upturn. Deciding on acceptable profit and loss levels ahead of time help reduce your risk, because you don't have to analyze and decide what to do while simultaneously monitoring an active position. All right, listen, we are trying to make money in a short amount of time. So a lot of times we don't cut our losses and we end up exerting more energy and time. Time is our most valuable possession. It's more valuable than the money. It's the time. All right, so cut your losses. I've learned that and I'm still learning that, but I noticed let's say my stop loss is $50. If we get to $50 and I hold on, and next thing you know, we go from 50 to 150. Now I gotta wait another 2, 3, 4, 5, 6, 7, 8, 9 days probably till we come back up to break even, or back up at least to my stop loss, my original stop loss, when I could use those 7, 8, 9 days to go the other way. I could have cut the play and hopped back in and rolled it down. I could have cut the play and moved on to something else that was moving up. So we have to prioritize stop losses and our exit points. Sticking to your exit plan can help you get more consistent results from your trading. Rather than trying to maximize your profit on every trade, focus on establishing a successful trading pattern. It can be tempting to divert from your plan in hopes of a better outcome, but remember the goals you are trying to achieve and why you created the plan in the first place. Sticking to a plan is the best way to prevent your emotions or fears from controlling the outcomes of your investment. If you're new to trading options, there are many concepts and strategies that seem deceptively simple, straightforward, or easy to profit from. But no position is without risk, and everything comes with a trade-off. When you divert from your plans in hopes of reaching huge profits, you often also risk huge losses. Developing a strategy that is consistent with your investing goals, the amount of risk you are comfortable assuming, and how long you're willing to hold a position, and sticking to that strategy is the foundation of options trading success.